Jeremy Fernandez, welcome to our special live stream to answer your questions about the COVID-19 crisis. We've had a lot of economic data this week and it's beginning to show the effect of the pandemic on Australia's financial position. So we're dedicating this stream to answering your questions around financial markets, business operations and how Australia is aiming to keep its economic position in check while supporting millions of Australians transitioning back into work. Please leave your questions in the comment sections below and we'll get to as many of them as we can over the course of the next 40 minutes. But to be clear, the analysis and observations you're about to hear is general in nature. It doesn't constitute financial or other professional advice. Why is that? Because none of us really knows your particular financial position or objectives. So before making any decisions based on the information you're about to hear, you need to consider what your own financial position is and perhaps seek advice on that as well. Now, joining us is one of Australia's most respected economists, Saul Eslake, and he's with me from Hobart. And in the studio is host of The Business, Elysse Morgan. Welcome to both of you.
Thanks so much.
Thank you for having me, Jeremy. Hello, Elysse.
Right, let's get straight into it. Having read that disclaimer at the start, Saul, I want to ask you, how much can you reliably predict about where the economy is headed in the short to medium term?
Jeremy, I'd say this is the most uncertain environment in which to carry on the business of economic forecasting that I've experienced in almost 40 years of doing this sort of thing. Any forecast that a government or a bank or an independent economist like me offers is surrounded by more than the usual margin of error or uncertainty. So while if people want to ask what my forecast is for something, I'll give my best attempt to answer it. But I find myself that I'm changing my thoughts about how economic events might unfold on a weekly, if not a daily basis as new information comes to light. Sometimes that's been to become less pessimistic, sometimes it's to become more pessimistic, but we're going to be in very uncertain waters, I think, for probably 3 or 4 months before the shape of what sort of recovery we're going to have becomes clearer.
Elysse, there really are so many different factors at play all at the same time, not just domestically but internationally as well. It makes it, as Saul says, really difficult to predict where things are headed.
It's incredibly difficult to predict, also because it's the cliche of it's not just an economic crisis and it's not just a health crisis, it's the two combined. And there's so many unknowns on the health side that it makes it impossible, as Saul would know, to model. Because, I mean, models at the best of times are pretty tricky beasts, but when you have so many variables going into the inputs, it's almost impossible. And you only have to look at the big four banks who reported over the last month and gave us some key insights into what they're forecasting and what they're preparing for to know that no one really knows. There was huge variances in between the major four banks in what they think is the likely outcome for unemployment over the next couple of years, house prices over the next couple of years, 20% difference in what two of the banks believe is going to be the fall in house prices. So it's so hard to know and to model, and then to be able to sort of create plans, etc., around this for governments, not just here in Australia, but all around the world.
And Saul, despite that, despite what Elysse says about the banks, withholding their dividends and making these sorts of predictions, we are still seeing that there's a degree of confidence in the stock market. When you look at the housing market, there's a degree of confidence that, oh, look, inspections are allowed in person again, so that will help boost the housing market. The jobs figures came out this week and they weren't as bad as many had predicted they would be or had expected they would be. How do you explain that? That's those traces of optimism that we still see around there?
Well, in Australia, I think you can put a lot of that optimism down to the success that we've had in containing the spread of the virus, in minimising the demand on our health system, and of course minimising the number of deaths and serious cases. And that in turn has laid the basis for starting to open up the Australian economy, allowing businesses to reopen and people to go back to work much earlier than had seemed likely just a month or so ago. Remember when the Prime Minister and the National Cabinet first announced the social distancing requirements that we've been living under for the last 6 weeks, he was saying that they would probably last until the end of September. And most of the support mechanisms that governments have put in place are likewise designed to run for another, 4 months almost. And yet here we are halfway through May, and most states and territories have begun the process of allowing people to start going back to work. We know that there are some areas, particularly those that involve people crossing our international borders, that are going to remain closed for quite a long period of time. But putting those to one side, I think if you cast your mind back 4 or 5 weeks, you probably wouldn't have imagined that shops would be opening and that building sites would be resuming work. And as you said, people would be allowed to personally inspect property. So things have moved more quickly, more favourably than seemed likely 4 or 5 weeks ago. And financial markets, being forward-looking creatures as they are, have been factoring that in really since late March. Now, there will almost certainly be setbacks. We know that some countries aren't doing as well as others, and some of those countries are important markets for us. Our governments have warned us to expect that there will be outbreaks as we do start to return life to something approximating normal. And even today, for example, we know we've had the largest number of new cases confirmed since, I think, the 19th of April. I hope that's not a sign of things to come, but it does serve as a reminder that, as I think the Prime Minister has said, the virus hasn't been defeated, it's been contained, but it's still out there. And if we're not careful to observe the rules that governments are laying down for us, we could well face a renewed outbreak. And if we have to reimpose restrictions again, then I think the consequences of that for business and consumer confidence could be worse than accompanied the original introduction of those restrictions in late to mid-March.
Elysse, we've had a number of people asking this questions about how stable the markets are right now. One thing we haven't seen flow through is how these are affecting the profits of various companies, because we haven't had a reporting season yet, really, since this outbreak really took hold in Australia. Will that impact the confidence on the market further down the track as the economy absorbs the full shock of this pandemic?
You would have to say that that's when things are going to start to get real for
Sober up
markets.
A little bit, yeah.
In the US, they've got a different reporting timetable to Australia. They've just come through their corporate reporting season, and it was relatively good because the majority of the companies had wrapped up their books and wrapped up that year well before really coronavirus and the shutdowns and the effect of that really started to take hold. And then a couple of them also added in different qualifiers, so sort of polishing the numbers a little and say, well, if we hadn't had that coronavirus effect for the last month of the year, this is what the profit would have been, and it would have been much better. And the other thing with the US is they've had around $3 trillion pumped in over the last couple of months from the US Fed. So that has just been lolly water to markets that have already been high on sugar from the candy bowl for the last 10 years. They've just been pumped up and pumped up and pumped up. And if you look at the S&P 500, it's up, 30% since that low that it hit in March. So it just goes to show that no one's really thinking through for the moment what the fundamentals of this catastrophe means for company performance. If we bring it back to Australia, we've got until about August until we get another look at company books, and they are going to be a bit of a horror show for a lot of companies. As Saul would attest, it's not going to be great. We already are getting a bit of a flavour of that from the banks, and particularly for Commonwealth Bank. They report outside of the cycle. They just gave us this week a look at a third quarter update, and it's not going to be great at all. And you consider that so many businesses have just gone into hibernation. We've got massive businesses like construction giant Mirvac looking to put a lot of its workers on JobKeeper. If you've got a huge company like that, already trying to find financial assistance when we haven't even really seen a big drop in construction yet, because I mean, there was a huge momentum going into this. We haven't seen the tail off yet. If they're already going and looking for help, then you can imagine that there will be some significant pain showing up when we finally get a look at the books. The other thing that we don't know what's going on is the regulators have said to companies, you don't need to keep updating the market as things shift. Because of coronavirus, we don't know what's happening. It's all very new. It's a sort of a situation that no one has really been in before, where the government has literally just shut down the economy. So you don't need to keep updating the market and telling us when things materially change. So we're also a little bit shielded from a constant flow of information that we would normally otherwise get.
Saul, that horror show, as Elysse puts it, is it going to be fairly even across the economy, or are there going to be particular sectors that are more vulnerable or more insulated than others?
Well, Jeremy, we already know that there are some sectors that have been much harder hit than others. In particular, services sectors such as accommodation and food services or tourism, restaurants, the arts and recreation and sport have all been much more seriously affected than, for example, mining, agriculture, manufacturing and construction, as Elysse has been saying.
The supermarkets.
Supermarkets have certainly done very well, particularly in March, when we had that surge of panic buying that was almost unique to Australia. Nothing like that happened in the United States or Canada, or as far as we can tell from the available data in Europe. That was just a unique Australian contribution to the data. What we're going to see over the next month is some more horrible data, like the employment numbers we saw yesterday. And although the unemployment rate didn't rise as much as expected, almost every other dimension of the labour force report for April was really horrible, was the worst that we've seen since the monthly series began way back in 1978. And the employment report is usually the first statistic that comes out for any given month. So over the next few weeks, we're going to get bad retail sales data for April. We'll get bad building approvals data for April. We'll get bad motor vehicle sales data for May. And although there are some other signs from more timely, unofficial data that suggests that the economy probably is now somewhere around the bottom and beginning to turn around, that's not going to show up in the usual official series until sometime in June. So again, you'll probably see financial markets ignoring this bad run of data we're going to have over the next 3 or 4 weeks, provided, of course, that the news on containing the virus and the signals we get from overseas markets don't scare local investors.
Saul, I do want to come back to this question about the unemployment figures and how JobKeeper and JobSeeker are going to go over the next few months. But I do want to come back, pick up on something you mentioned a moment ago. That was mining. Mining was really critical in helping getting Australia through the GFC. How badly affected is mining this time around, and particularly in consideration with the relationship we've got with China at the moment, which is fairly testy in terms of that bilateral trade?
Yeah, that's really a really interesting dimension of this, Jeremy. So far, mining seems to have been remarkably little affected. And although you're right to say that mining helped us out of the GFC, when the GFC first struck, the mining industry was very hard hit. Commodity prices plunged and companies put investment plans on hold. And then, of course, we had this massive fiscal stimulus from China that allowed the mining industry to rebound very strongly, and along with our own fiscal and monetary policy stimulus was one of the things that helped us be, I think, one of only 3 countries among advanced economies not to have experienced a recession by the normal definition of that term during the financial crisis. But this time around, although oil prices have plummeted, and that probably spells difficulties for LNG prices that are linked to oil on the spot market, the other commodity prices that really matter to Australia have held up remarkably well. I mean, coal prices have continued to drift lower, but not at any faster rate than they had been before the outbreak started. And iron ore prices have been remarkably stable. And so too, it would seem, based on company reports and on the most recent trade data from the ABS, the volumes of those exports have also held up fairly well. So although, as you say, we're having a number of trade disputes with China at the moment, and it looks as though there are more serious problems in the bilateral political relationship that may have adverse consequences for us over the medium term, China probably doesn't have any near-term alternative to buying iron ore from us. Yes, they say that they could buy some from Brazil, but Brazil has encountered some ongoing significant supply problems now for almost a couple of years. And likewise, while there are alternatives to Australia for thermal coal, for the metallurgical coal that's used in steel making, there aren't too many readily available alternatives for Australia. So mining is doing very well, and I expect that it will continue to do fairly well over the period ahead, unless there is a very serious downturn in the Chinese and maybe some other Asian economies, which doesn't seem to be happening at the moment. We had more data out of China earlier today, which showed a further pickup in industrial production. Domestic demand, retail sales in China is still fairly soft, but the industrial side of the Chinese economy, which is what drives a lot of their demand for our iron ore and other commodity exports, seems continued to have recovered quite smartly through April.
Elysse, I'll get you to weigh in on this, particularly around the relationship with China, because a lot of the questions we received range between worry about that relationship with China to anger to, whether Australia should enter a retaliatory arrangement as well, as the US has. I wonder what you make of that relationship and help us put in perspective about how concerned or alarmed or angry people should be about that.
Well, I mean, we do have already some tariffs on Chinese goods coming into Australia. A random item is steel pipes, and I read this morning that we've got a tariff of about 114% on Chinese steel pipes coming into the country. So there already is an interplay between Australia and China about what we send to each other and, whether we're necessarily happy to accept those goods. If not, we'll whack a tariff on them. So there are tariffs that exist between the countries already. And while there is a lot of this, headline-grabbing tit for tat between commentators and ambassadors, etc., keep in mind that our iron ore export volumes out of Port Hedland are up 11% year on year. So from April last year to this year, we're pumping out a lot more iron ore into not just China. Our iron ore does go to, as Saul said, other Asian countries, including South Korea and Japan. But of course, China is the major market for that. And the iron ore price is holding up at around $90 a tonne. Like, that is a stellar outcome for Australia, particularly at this time. It's well above Treasury's forecasts of where it would be when we had the budget last year. I think, Saul, you may correct me on this one, but I think it's about $35 higher than where it was forecast. So that's a good outcome for us. It's a boon that wasn't already factored in. We're still shipping a lot of stuff to China. It's a huge market for us. We take a lot of stuff from them. It's not something that we should be saying, oh, we've got to throw up walls. We are a trading economy. We are an open economy. While there is, headlines going on about different things, there's still a lot of trade happening.
Which is the approach, I guess, Julie Bishop has been advocating for, is that a lot of these talks, a lot of that relationship building and maintenance should take place behind the scenes, behind closed doors, away from that headline-grabbing material.
Well, I mean, when all of this kicks off, and we've had issues before of things getting held up on ports or being held up in waters just outside the ports. Iron ore, coal. I think coal was held up for some reason. I think it was last year or the year before. We've had baby powder, milk being held up in customs before for reasons that haven't been entirely clear at the time. And, always there's suspicion that, or perhaps it's politically motivated, or perhaps it's, protectionist, whatever it may be. we're still shipping a lot of stuff into China. It's still worth a lot of money to our exporters and to the economy. A lot of regional producers send a lot of stuff into the country. So it's definitely something that's a trade route that's definitely worth protecting, and conversations should definitely be held about keeping that as open as possible.
Saul, how dramatically is this going to affect our supply chains? I mean, as Elysse says, we import a lot of stuff from China, we send a lot of stuff to China, and there's a lot of talk now about, the limits of globalisation, and that, this might just be the return of Australian manufacturing. Is this going to be dramatically cause a dramatic shift in the way our supply chains work, do you think?
Jeremy, I think it will cause some shifts in some areas, and in a handful of those areas, the shifts might be quite significant. But looking across the broad spectrum of Australia's economic relationship with China, I don't think it will be all that dramatic. It's certainly true that Australia is more exposed to China than almost any other advanced economy. Something like 35% of our merchandise exports go to China. That's a higher percentage than any other advanced economy, and a higher percentage than many other emerging or commodity exporting economies like Brazil or Canada or Indonesia, for example. We also are more dependent on China than almost any other country that matters to us, with the exception of Indonesia, on imports from China. We're one of the few countries in the world that runs a trade surplus with China, which does, in a sense, make us more vulnerable to pressure from them than the United States, which runs a huge deficit with China. We, on the other hand, are one of the few countries that runs a trade deficit with the United States, which may be one reason why Donald Trump seems to like us, even though he enjoys poking his finger in the eyes of most of what used to be friendly countries to the United States. As I say, I suspect that the Chinese don't have many alternatives to our exports of iron ore and coal, and probably in the short term even of LNG. But they could, if they chose, inflict some significant damage on a wide range of our agricultural exports and on our tourism and education sectors, if they so chose. And the Chinese ambassador to Australia was fairly belligerent in the language he used. I certainly agree with Elysse that it's far better for whatever response we choose to make to be made quietly rather than in a way that provokes further tensions with Beijing. But nor, on the other hand, do I think it would be appropriate for Australia to back down from some of the positions that it's taken. I suppose I should also say that we're not completely innocent abroad. We're innocents abroad when it comes to restrictive trade measures. Australia has been one of the most active countries in the world in the use of anti-dumping measures as a form of restricting imports. And we do need to remember that while it's legitimate concern to ensure that we have adequate supplies of things that we might really need in emergencies, and the coronavirus epidemic has highlighted that in terms of things like medicines and ventilators and personal protective equipment and the like, I can understand that we might see a greater need to ensure that we have our own capacity to produce those things. But if we start spreading it much more broadly and start saying, for example, we need to have our own clothing industry back, or we need to have our own motor vehicle manufacturing industry back, or household equipment manufacturing industry back, what we'd be in effect asking Australians to do is to pay much higher prices for what, if history is any guide, were less well-made goods, purely to satisfy some urge for self-sufficiency that isn't as necessary as I think it might be in some of the medical or pharmaceutical areas. So I think we need to think sensibly about this and remember that tariffs are not something that you make foreigners pay in order to get their goods into your country. They're something you make your own citizens pay, your own consumers pay, in order to keep foreign goods out of the country. And that's one of many economic principles that Donald Trump completely fails to understand. I'd like to think that, and I do think that Australia's governments have a better understanding of economic principles than he does.
OK, I'd like to move on to the unemployment state of the country right now. We see some figures coming out this week, 594,000 people losing their jobs. That number goes to 2.7 million people when you consider how many people have either left work or had the number of hours cut at work. Saul, how great is the risk of long-term unemployment for these people who found themselves either unemployed or underemployed?
Well, the risk is greater the longer the shutdown lasts, or if it happens to be reinstated. We certainly saw very clearly after the recession of the early 1990s that, first of all, it took a lot longer for unemployment to fall than it did for unemployment to rise. And secondly, that those who were unemployed for a long time, for more than 12 months, found it increasingly difficult to get back into work. And if they were able to get back into work, it was usually at significantly lower pay. And that's why it is important that the government does what it can, and it has been doing what it can at considerable expense to keep people connected with jobs and to keep their employers viable so that they have a job to go back to when the shutdown ends. And I think it will be important for the government to support ways of creating new jobs once the worst of this pandemic is over, because we know that not everyone who's lost a job now will find it easy to get one back, and we want to avoid, I think, as much as possible, having a large pool of long-term unemployed in this country, because that would carry a very significant human cost for the people affected and their families, as well as, of course, an ongoing cost to the economy.
Elysse, a lot of this, as Saul said, is being put down to JobKeeper, just buffering those numbers a little bit. Is it inevitable that we will see much greater unemployment further down the track?
That's certainly the risk, given that we've got 6.1 million workers now on JobKeeper. What happens at the end of September when the government has made it very clear that that program will finish? Whether there is then another program that comes in that's more targeted towards particularly affected sectors like tourism, we don't yet know. There is some sort of review going to be held by the end of next month, which will look into it and give some guidance, we assume. But 6.1 million people essentially being tied to their employer by a government payment would indicate that there is enormous stress for those employers to be able to keep those people on. And of course, you can't just, it's not available to everyone. You have to be able to demonstrate that your business is under extreme pressure in order to access that. So that is a key concern, that once that JobKeeper program rolls off, if we don't see a lift in spending, a lift in activity, enough for employers to be able to afford those staff without that government subsidy, it is likely that there will be another spike in unemployment. Saul, do you concur?
Well, yes, I think that is right, that if there is a risk of a significant increase in unemployment if when the JobSeeker program expires, if it does, as currently scheduled in the last Friday in September, that people currently being kept on payrolls by the JobKeeper program will become effectively unemployed. Whether they show up as unemployed in the labour force survey obviously depends on whether they're actively looking for work, as the ABS defines it. But clearly that's a risk, and that's why I think the government will need to consider other forms of fiscal stimulus to replace the JobSeeker payment, assuming that it does terminate when they end. And they could be more traditional forms of fiscal stimulus, such as temporary increases in grants to first homeowners, or infrastructure programs, such as has been suggested, and I think quite sensibly, a program to build more social housing, which is something that's labour intensive, basically uses domestically produced rather than imported materials, and can be spread pretty broadly around the country. There might be other bigger infrastructure projects that are, as they say, shovel ready, that could also be brought forward. And the government may want to consider another round of cash payments to low-income households, of which there are two. One we've already had, another one is slated for the next quarter, I think. But some of those measures might well be necessary necessary to minimise the downside risks to employment that we'll face when the JobSeeker program ends.
Because the other thing with the official unemployment number being at around that 6% mark, because of that JobKeeper program tying people to their employer, it means that a key indicator that we should be looking at, not the unemployment number itself, because it's sort of become artificial now, but the number of hours worked is absolutely key. And that actually tells you the truth of the activity in the economy. And it's plunged, I can't remember the number off the top of my head.
9.2%.
Yeah.
It was 9.2% in April.
And that's the sharpest decline that we've ever seen, and that tells you that there's been employers are now keeping people on the books, paying them JobKeeper, but not getting them to do anything. And so, if they don't see a pickup in orders, if they don't see a pickup in demand, are they going to want to or be able to keep these staff on? Maybe not.
We've spoken about the prospect of supporting people beyond the 6 months for the JobKeeper. We did receive this question through our website, though. An employer has told an employee here that these JobKeeper payments might actually be withdrawn sooner than 6 months. Saul, is that likely to happen?
I don't think so, because the legislation that Parliament passed last month specifically provides for the scheme to run until the 28th of September. As Elysse mentioned, there's going to be a review conducted next month, and that may well look at some anomalies in the scheme, such as the fact that there are a number of people who were working a small number of part-time hours who are actually getting paid more under JobSeeker than they were earning when they were working part-time. I mean, that's clearly an anomaly, and if the government wants to tidy that up, then I'd certainly support that. That may free up some funds to allow people who've fallen between the cracks, who, because they haven't been with the same employer for 12 months, or because they're foreigners who stuck in Australia and can't get home, students and that sort of thing. I know that the government has said you have to draw the line somewhere, and that's true. They may choose to draw the line somewhere differently as part of this review. But I think it would be both economically wrong and probably politically risky for the government to terminate this program before the scheduled date on the 28th of September.
It seems to have been coming from a number of backbenchers worried about the amount of debt that we're building up as a result of these unbelievably expensive, but you would have to say necessary programs, given it's a government-mandated shutdown.
Yeah.
But, I mean, today we heard from the Prime Minister saying that it will be maintained. We're only 7 weeks into it, so there's no urgent need.
It might have felt like forever.
There's no need to be changing it anytime soon, and his comments were that it would be very speculative to assume that there will be any wholesale changes to the program prior to September. So they were his comments today.
It's funny because it's been such a relatively short period of time that we've been enduring this, and yet it feels like because of the scale of change and the pace of it, things have been moving a lot faster than they really have. I want to ask you a question that a lot of people have been writing into us wondering about. Are house prices going to crash? And I think we get a lot of this question because a lot of people have their personal wealth, their private wealth, tied up in real estate. So, Elysse, are house prices going to dramatically fall? You see the predictions of up to 32% by CBA this week, depending on how long this pandemic and the crisis lasts for. What's your view? What should people consider in assessing that?
Look, I'll give you the range from the major banks. I mean, these are the guys that have got the most skin in the game when it comes to whether or not house prices in Australia crash, because they're the ones that have lent all the money out. So from Westpac, they've got their base case is for a 20% decline in house prices from this year to next year. ANZ's predicting 12. The Commonwealth banks base case is for 11. The worst case is 32% fall, and the National Australia Bank is predicting 12% over the next 2 years.
They're all over the place.
They're the range.
Yeah.
And these guys are the so-called experts. They are looking into every part of our lives. They know what we're spending, where we're spending, how much we're saving, and how much into the red we are. They also know that about businesses in the economy. All of the small businesses that are really the engine room of this country, they're the largest employer as a group. That is really going to dictate what's going on. It's all because we don't know how long these lockdowns are going to last, whether we're going to see a bounce in activity, whether we're going to keep a lid on the virus. Will businesses be able to open up? Will we be able to open up our borders? A key input into house prices, of course, is demand, both to buy and also to rent. And a key part of that has been migrants, people coming into the country, both to permanent migration, but also students. And that has left an enormous hole in demand for housing. It depends on how quickly we can open up those borders and whether we allow the 200,000 people that we've been allowing in for permanent migration over each year, whether that number returns or whether we lower it really makes a difference to these house prices. But in all honesty, if you look at the basic fundamentals, you think, okay, confidence is way down, both for consumers and for businesses. Spending will eventually drop significantly as to follow confidence. And also as we see, you know, this is the shock, but then we see the tail and we will see a recession. In a recession, will house prices hold up? Probably not. That's just common sense, right? So whether it's 32% or whether it's the 12% over the next 2 years, we won't know until we're in it, because it's all about the shape of this recovery and how it pans out.
Saul, I'll get your weigh in on that, on whether house prices are heading south, and when will we know if we're at the bottom of it?
Well, I'm glad I don't have to put numbers on house price forecasts for a living anymore, as I used to do. But I think Elysse has sketched out the major factors that are going to influence house prices pretty well. In the first instance, migration does represent a huge proportion of the normal demand for housing, and Treasury has apparently advised the government that in the coming financial year 2021, we're only going to have about 36,000 migrants compared with the 168,000 that they expect for the financial year that's about to end, and with numbers, as Elysse mentioned, of over 200,000 per annum in recent years. So that's a huge hole in the demand for housing coming from that source. I suspect also we'll see some increased selling pressure coming from that proportion of existing homeowners or investors who've taken mortgage repayment holidays. Apparently about 9% of people with mortgages have taken up the offer to defer repayments until the end of September. There's that deadline again. Also affects the mortgage market. And those people are going to face higher or longer repayment periods when that mortgage repayment holiday is over, because banks haven't been foregoing or cancelling the interest. They've instead been adding it to the outstanding principal. And there'll no doubt be a number, probably not a big number, but there'll be some people who find themselves in a position where they've got higher mortgage repayments but still haven't got the sort of income they had when they first took the loan out. Some of those may become forced sellers, and there may be other investors who'd been counting on renting out their investment properties as B&Bs rather than long-term tenancies, and that's probably not going to be coming back in the same way as it had for an extended period of time. So I think we'll see some selling pressure from that source. On the buying side, it may well be that people are more nervous about how secure their employment is or how secure their income is going to be if they've returned to work but aren't working the sort of hours that they had been before this outbreak started. So I think there'll also be some downward pressure on demand, and in that environment it stands to reason that house prices are more likely to fall than rise. I suspect if it looks as though house prices are going to rise by amounts at the lower end of that range that Elysse mentioned, something between 20 and 30%, then you'll probably find turnover drying up, and that people who don't have to sell will simply take their properties off the market in the hope that if they wait another year or so, they'll get a better price. And so the market may become a little bit artificial. But I certainly think it's reasonable to expect that house prices will decline some as the market reopens, and probably remain on a downward path until the outlook for migration in particular becomes clearer than it is at the moment.
Elysse, just finally, I want to put this question to you. You mentioned the enormous amount of spending that we're seeing by the government right now. Are we going to be forced into a period of austerity and reform immediately after this crisis? And how deep and profound is that going to be?
Well, this is going to be something that not just this government but future governments of Australia are going to have to wrestle with, because at a bill of, I think we're up around 300 billion so far of a black hole, that's not something that we're going to be dealing with only within the term of this current government. Austerity is a particularly dirty word that we've seen it play out across Europe and the UK, and it has really hurt particularly the younger populations in those countries. Is it something that they would be able to really do in Australia in the same way? Possibly not. It's hard to say, while we're in the crisis, how we'll dig our way out of it and what would be palatable or not. I suspect over the coming months we'll be playing the usual game of what's on the table, what's off the table. The usual suspects have been coming out with the usual things that they call for. So you've got, the Business Council calling for business tax cuts in order to stimulate activity, lower the cost burden on them so that they can employ and they can invest, etc. You then have the other end of the scale of the welfare groups, etc., saying a key driver of the economy to help us out is to continue to lift the New Start amount. Do not go back to the appallingly low New Start level,
which was a point of contention before this pandemic even began.
And keep it at the current JobSeeker level, which has of course been at the $750 boosted by the $550 a fortnight sort of corona bonus payment. Keep it up there, or at least something close to that, which will help drive activity, put more money in people's pockets who are more likely to spend it at the bottom end of the scale. They're more likely to spend any cash that they have, get that into the economy, boost activity. That way, that generates new taxes. We've already got the New South Wales government suggesting that they would like to get rid of stamp duty to exchange with something else in order to, lift the burden on property and continue to keep the property market flowing. So I think there's going to be a whole range of policies that are going to come to the table, and it will really be a wrestle as to what is going to come out of this mix.
Saul, do you have a view on what people can expect to be ripped away from them? I mean, the question we get repeatedly is whether the free childcare scheme is going to last much beyond this pandemic.
Well, I don't think the free childcare scheme will last beyond this pandemic any more than the JobSeeker payment will, or the coronavirus supplement will, beyond the time period that the government has indicated, although I agree with the people that Elysse referred to that the New Start allowance, or JobSeeker allowance as it's now called, shouldn't revert to the $40 a day level that it was beforehand. And even the Business Council and even John Howard agree that that payment is too low and shouldn't be taken back there. But more broadly, Jeremy, I don't think we need to panic about the level of debt that we will have. I mean, yes, it's going to be a lot higher than was forecast, but particularly if interest rates remain very low for a long time, as I think they're likely to do, as the Reserve Bank is telling us that their intention is certainly to keep interest rates at very low levels for a long time, we can afford to carry and service this debt. And if we were to pay it off, the only way you can start to pay it down is by running budget surpluses. The only way you can run budget surpluses from where we are now is, apart from getting the economy back to full capacity, which ought to be a priority, is by some combination of raising taxes and cutting government spending. And if you do that while the recovery is fragile, as I think it's likely to be for a couple of years, the risk you run is of setting back the economy, making the deficit bigger again, and thus just compounding the problem that you're trying to solve. We don't face nearly as much of a problem with regard to public debt as most of the countries we typically compare ourselves with. We went into this with total public debt of the order of 25, 28% of GDP, if you include that of the states and territories. The average advanced economy went into this with government debt as a proportion of GDP of 85% and is likely to come out of it with public debt to GDP ratios of over 100%.
I think that the US is already at about 130, isn't it, Saul?
That's right. And I think, yes, that's That's right. So's the UK. Japan, it's over 250%, I think. Italy is somewhere in the high 100s. And here we in the Scandinavian economies in New Zealand are down somewhere around the 25%, although New Zealand's budget that came out yesterday, and you sort of wonder in passing, how come New Zealand can put together a budget in this uncertain environment, but we somehow aren't able to. I'm not sure why that's so, but I suspect you're going to see in countries like the UK and the US and Europe and maybe in Japan, various unorthodox measures floated for dealing with the debt, such as cancelling that part of the debt that's held by central banks or in some other way trying to inflate it away. We don't need to go down those paths either, but I certainly think it's important that we don't beat ourselves up into taking panicky measures to reduce the budget deficit and to reduce the level of public debt until the economy is in a much stronger position than it's likely to be for the next 18 months to 2 years.
Saul Eslake, it's been terrific to have your insights on the program. Thank you so much for joining us. Elysse Morgan in the studio with me. Thank you both very, very much.
Enjoyed it very much.
So
Thanks for having me, Jeremy.
And thank you to the viewers as well who've been leaving us your questions all week on the ABC News website and also on Facebook and YouTube. We'll be doing this live stream again next week, so I hope you can join us then. In the meantime, stay safe, take care, and we'll see you again soon.